Good morning, everyone. When Philip invited me to speak at this event a few weeks ago, needless to say, it was a wonderful invitation. Thank you so much. Things have changed so much since then. So it forced a complete rewrite of what I was going to say. But it also helps us with the central question. Where are we and where are we going? So today I'm going to focus on three things. One is where we were in terms of the economic cycle before this shock, and I'm of course referring to the Iran war. Second, I'm going to explain the mechanism that we're watching as to whether or not this is something that will be structural in nature long-term or a temporary phenomenon. And then third, I'm going to show what we're watching in markets to know which scenario it's going to be, either temporary or more permanent. So the economy, and this is the basic premise of my thesis today, the economy entered the shock in a good position. Okay, so whether it remains resilient depends on one thing alone: the duration of the closure of the Strait of Hormuz. That is it, okay? So I'm going to ask you all a question to kick things off. And you can open your phone, go to the event app, go to Global Market and Economic Outlook session to answer the question. There's two poll questions. It'll be very useful for me to see what you all think, and then I'll give you my scenario analysis. So the question is, before Iran, what concerned you? And if you can see the options there should be a few of them. Economic recession, stagflation. There's four different ones: recession risk, inflation comeback, a China shock, or Europe, or something breaking in markets. I'll give you like 15 seconds to answer this question. And I already see some results coming in. And it's interesting, as I see these results, recession risk and something breaking in the markets, as well as inflation comeback, they're kind of leading the pack. Recession risk and inflation comeback are running the strongest. And that's dead on. Why? Because now we're facing one primary risk. And that's something called stagflation. Stagflation is where an economy decelerates, which is what the US economy was doing before the shock. But it decelerates below its potential rate of growth, and inflation moves higher, and sustainably so. So this is the right take, in my view. Both recession and inflation comeback. I would push back on one thing, which is before the shock, recession risk was remarkably low. And we'll pass to the next slide. Here's why. Okay, these are the key indicators that I look at. And why do I care so much? I care because where we came into the shock determines how we should analyze it and put it in context going forward. US GDP in 2025, 2.2%. That's on par with trend growth and potential growth. That was a deceleration from the previous year, which was above 2.5%. Unemployment rate ticking higher, 4.3%, still historically low. Core PCE, sticky, above the Fed's target for the fifth consecutive year, 3%. The target is 2%. But productivity, and this is where I care a lot, productivity grew 2.2%. Actually, in the fourth quarter, it grew 2.8%. So the key point here is that before the shock, recession risk was low. The baseline was resilient. The current risk right now is an exogenous energy and supply shock. And I didn't mention, but please do ask me questions in the mobile app as I'm speaking, and I'm happy to review them and answer them. So where are we now? There are a push-pull of factors. We have inflation, things that are happening now. We have swing factors, as I mentioned here, and we have disinflationary forces. I would call them hopes. On the inflation side, we have energy shock risk. That means higher fuel prices, especially in the time of peak driving season. We have two peak driving seasons in the US. One is the beginning of the summer in May, and one is in midwinter. Okay, and we're about to hit those times. And freight costs have skyrocketed tariffs and supply frictions have already, everyone, pushed durable goods, which are, things that you consume, higher. Durable goods was contributing negatively to inflation. Now it's positive. Okay, and that's due to tariffs. And the third thing is core inflation is still above target and has been for 5 years. That's a problem because then you get anchored inflation expectations. And that means that expectations continue to move higher. The bottom line here, I'll repeat, is duration is the key variable. If this shock lasts, and I'm going to put a time frame on it to be very specific, more than a specific period of time, I'm going to put it at 2 weeks, then we revert back to the resilient economy because the shock fades. The shock fades and it's not intrinsic in growth or inflation. If it persists, inflation reignites and we're facing an entirely new world. Okay, here's the deal. Look at this graph. The Strait of Hormuz is, and we have a huge commodity component here in the company, but 20% of energy passes through, specifically oil, passes through the Strait of Hormuz. 18% of the world's gas passes through the Strait of Hormuz. What people don't know, and I'll let Arlen talk about this in the panel later on, but fertilizer does too. And this could affect food prices later in the year. So all of these things are happening right now because tanker traffic has collapsed to zero, everyone. Zero. So pre-shock, normal crossings were about 200 on average. It's now effectively zero. This is a massive choke point. The duration of the impairment is going to determine the impact on not just the U.S. economy, on the global economy. Here's the day count. And Sean, you mentioned 2 weeks. You nailed it. It's 2 weeks. So what we did was we looked at what is the major issue here? It's storage. So when you have the GCC, the Gulf countries that are massive oil producers, they have to get that stuff out, right? If they can't, if the storage facilities are at capacity, they then have to cut production. So how many days do we have to then? I created this, things changed, but I created this at day 5. We're now at day 7, day 8. We're at day 7 or day 8. Iraq and Kuwait storage fills at day 7. Iraq is done, okay? So we're gonna start facing destruction of production starting today. Saudi Arabia and UAE, their storage capacity is on average 20 days. So 20 million barrels per day pass through the Strait of Hormuz. If in 2 weeks this remains effectively shut, my rule of thumb is the following. I'm going to give you very clear guidelines here. For every 1 million barrel per day taken off production, that will add $4 to the price of oil. We could very well be facing $120 barrel per oil over the course of the next 2 weeks. Okay. So the bottom line here is the market can't wait out a prolonged disruption. If disruption ends in less than 2 weeks, then we revert back to where we were before. The shock fades, and that's historically what happens with shocks in oil prices. If it lasts greater than 2 weeks, this becomes a physical supply loss production, okay? I think we need to go back one. I might have skipped. If you could go back. Okay, no, we did not. Okay. So we're facing a fork in the road. This is the fork in the road. The disruption can take 2 very different macro paths. Scenario A, oil spikes, flows resume, insurance normalizes. Because why are tankers not going through the strait? It's not because Iran's Navy has shut it down. It's because insurance costs are too high. They don't have the insurance. They can't pass through. So insurance normalizes, the shock fades, oil mean reverts back down to $70 to $80. The Fed, everyone, in scenario A, delays cuts, but cuts by the end of the year. This is my view. Scenario B, storage fills, production is slashed, second round effects begin. Oil goes to 120, could go higher. Core PCE rises above 3.5%. This is over a sustained period of time because remember, core PCE doesn't include energy, but the pass-through does. It ultimately does affect core PCE. So we have to watch the plumbing to know which branch we are on. A brief disruption, adds $10 to $20 per barrel. 1 to 3 month infrastructure damage, I think could get us to even 150. Okay, so let me do another poll. 12 months from now, what are we going to be talking about? So please, once again, jump in there. Give me your thoughts on where you think we will be in the economy. Soft landing, are we going to resume back to where we were? Because effectively before the shock, we were in a good place. Stagflation, which means high inflation, slowing growth to below potential. Maybe I should throw this in there. My forecast for this year was an equivalent 2 to 2.2%. Potential in the US is 1.8 to 2. Recession, which is negative growth, and deflation. So recession is negative growth and negative inflation, or an acceleration, which means an overheating of the US economy. Looks like we're polling at stagflation. Very good. I think that's the main risk. For sure, the main risk is stagflation at this point. Interestingly, before the shock, in my view, the main risk was something quite different. In my view, the main risk before the shock, given tax rebates, given fiscal stimulus, pro-cyclical fiscal policy, monetary policy easing, the resiliency of the U.S. consumer, was potentially the economy growing too fast and inciting inflation. Now stagflation is effectively the major risk, and I concur with that completely. But let's transition to the next slide. Let's go back one, please. One more back. Okay, inflation transmission. Now, these two charts show on the right GDP and on the left inflation. This gives you an order of magnitude kind of frame of reference of where we could potentially be. It's a fan chart. So within this range, we could end up if, in fact, headline inflation is affected by, let's call it, a $120 barrel per oil. We could see inflation rise 2 percentage points. So instead of 3%, we're at 5%. On the low end, we could see inflation affected by 0.6, so 60 basis points. GDP shocks, this is a simulation. This is something that I did just to give you kind of a frame of reference of where we could end up. Impact on real GDP could be between almost 1 full percentage point and half of 1 percentage point. So this is where we could be if this is a sustained impact, and if the duration extends. Where does this put the Fed? Where does this put the Fed? The Fed is in a tough spot, very tough spot. Demand shocks are manageable. Supply shocks are not. Supply shocks are what we're working with right here. So they could cut rates, and they would do that if growth breaks. They would do that if labor market softens even worse. If there's credit stress, if there's a financial shock, they would cut rates. But the risks are inherent in that. You can de-anchor inflation expectations. If anyone is looking at the markets now, you've seen a surge in short-term inflation expectations and a collapse in long-term. That tells us a lot. You could see oil shock and easing brings its own risks as well in terms of history. We look at 1970s. I don't think we're there yet because it's a different scenario, but the other issue that the Fed faces if they cut is a credibility risk, okay? And then you have the other side of it, which is holding or, God forbid, hiking. If the Fed hikes, history dictates that exacerbates supply shocks over the course of energy disruptions. So tight policy into supply shock could bring recessionary risk. Unemployment can spike and credit spreads gap wider. So it's in a tough spot. If you were to ask me, and probably I'm getting this question now, what are they going to do? I think they're going to hold. They're going to hold until the back end of this year. Duration sets the policy path. I'm going to refocus on that. Temporary shock, they look through it. Persistent shock, they stay tight. Productivity, I love this term. Productivity is the key swing variable. Is anyone familiar with this? Productivity is the amount per hour worked that you can get out of an employee. So the idea here, and what Kevin Warsh and what Steve Myron and the camp that wants to cut rates, what they're saying is that productivity is so robust, which it is, that they can cut rates because productivity decreases inflation. And it does. And productivity is good. This is, as my colleague says, and he'll be talking next, John Hilsrath said, this is not the 1990s, however. And I think that AI does not flow through into these productivity numbers yet. AI, we're all talking about it, we're not using it. Adoption is very low. So yes, productivity is excellent. We're at 2.8% 4Q, 2.2% for the full year versus 1.5% for the prior decade. It's doing great, and I suspect that it gets better. but it's not here yet, and it's not going to save the day. So productivity will not curb inflation pressures, especially with a massive energy price shock, bottom line. The thing that changes everything, and how do we know that AI has been adopted, is unfortunate, but it's something called creative destruction. The proof of concept, the way we know AI is successful, if all these massive investments are successful, is unemployment rises in a very big way, okay? People are displaced in favor of artificial intelligence. My view is that day is coming. It's not 2026. What does this mean for our clients? Okay, I think this is very clutch for this audience. For our clients, the first signals appear in operational markets, not in CPI. We're all talking about, we have freight guys here, Tom Benny, he's helped with the collaboration with my last piece. Shipping costs, freight, fertilizer, 1/3 of global exported urea transits through the Strait of Hormuz, 1/3. And planning season starts right now. So your clients are going to be asking about hedging risk. That could be, good for business. Shipping, charter rates are surging. We have over 3,000 vessels trapped in the Gulf. I talked to John Ratcliffe, and he was telling me that can be good for shipping, the shipping business. It can also be good for a couple other areas. One is oil exporters. Oil exporters do well. U.S. energy, it actually does well. The U.S. is the world's largest oil producer and LNG exporter, but the SPR is depleted, and the rig count is declining. So there are some lapses there. So this is what I'm looking at here. And then let's look into the markets, because we have some securities people here. Cross-asset positioning. This is not a prediction slide. It's a framework for positioning across scenarios. So with high conviction, both scenarios, I continue to like gold. It's been a great performing asset. Long energy and defense. These are calls that we've had since the beginning of the year. Long energy, it's a good call. Defense is a great call. Credit quality over high beta. Overweight commodity exporters just makes sense. I mean, the disruption has already happened. So we do see some impulse, both for inflation and GDP. Avoid long duration, avoid CCC credits. I think private markets are going to affect high yield. Avoid China A shares and Asian refiners. And that's the view on securities. Valuations at this point are different from past oil shocks. So we are extended. Valuations are rich. We should keep this in consideration when we look at multiples in this shock versus the shock in 2022, 03, 2002, and the median valuation of the S&P in all of these shocks was 14 versus 22. What am I watching next? This is what we're looking at. This is what's going to tell us where we are. We have 5 indicators here. Hormuz traffic. Do flows resume or not? How do they resume? That's going to be very tricky. War risk insurance. Can ships get coverage? Refined products inventories. That's going to be clutch. And inflation expectations. If they break above 2.5%, that's a persistent signal in my view. We could get credit spread conditions widening over 400 basis points, and that'll stress growth as well. So here's the bottom line, and with this I'm going to successfully wrap with my 15 to 20 minutes. Bottom line here is pre-shock, the soft landing held. That was our view. Our view wasn't recession. It wasn't overheating. It was that the U.S. economy is decelerating. Unemployment is rising gradually, which, by the way, everyone, is a historical phenomenon. Unemployment doesn't gradually rise as we've been benefited in seeing. It generally jumps. But in this case, it didn't. In this case, it gradually is rising. So what we were witnessing is a soft landing. It's the elusive soft landing that everyone, was long looking for, but discarded that term when it actually started to occur. The consumer was not broken. And in fact, I would argue that 1Q growth is going to be very strong because 4Q was ugly, but also because the big, beautiful bill is going to give some nice tax rebates to the consumer. And the consumer is still earning real wages that are positive. The second thing, bottom line, Iran introduces a major fork in the road. One path is temporary risk premium, and we revert back to where we were. The other path is a structural supply-driven shock. 3, the Fed is stuck. Core PCs at 3%. This is the 5th year of above target, and an oil shock on top, and a new chair transition. It's going to be on hold for the foreseeable future. Productivity has to continue to be above 2%. Above 2%, 4% wages are doable, okay? And if productivity can continue to rise, then the U.S. can sustain higher rates of inflation. And in fact, inflation will go lower. So for StoneX, fertilizer timing, shipping rerouting, and LatAm commodity position are the differentiated angles. Markets are pricing a premium. They are not yet pricing a change in the macro regime. Thank you very much. And that is my spiel. I will invite the panel now. Thank you.